So, if a major global conflict breaks out tomorrow, common sense says the global stock market is just going to absolutely crater.
Right. Yeah, that's the immediate assumption everyone makes.
Because, people panic, supply chains break, cities fall. You would fully expect the financial charts to look like a cliff face. But what if I told you that historically, U.S. stock volatility is actually 33% lower during wartime than it is in peacetime?
Yeah, it completely defies, our most basic understanding of risk. You have this massive influx of global chaos, yet the financial foundation underneath it all somehow stabilizes. It's really one of the most counterintuitive mechanisms in modern economics.
Welcome to the deep dive. Today, we are on a mission to unpack exactly how that happens, pulling from this genuinely fascinating piece of research in quirky journals. It's titled War Economy Chapter 14, Volatility Explained.
And it really is a fantastic breakdown.
It is, and if you are listening to this and wondering why this matters to you, well, whether you're trying to figure out if you should, touch your 401k, or you're just standing in the grocery aisle wondering why the price of cooking oil practically doubled overnight, understanding how armed conflict rewires the global financial system is a crucial shortcut to being genuinely well-informed.
Absolutely. And before we jump right into the mechanics of all this, just a quick note to you listening. Today's sources do touch on several real-world ongoing geopolitical conflicts.
Right.
So our goal here isn't to take a political stance or endorse any specific worldview. We are strictly here to unpack the financial data, the market psychology, and the economic mechanics outlined in the research.
Okay, let's unpack this because that statistic you just validated, that volatility drops 33% during wartime, is what economists actually call the war puzzle.
Yeah, the war puzzle.
And I was thinking about it, and assuming war destroys the broad stock market is like expecting a hurricane to demolish a house, but then finding out the storm somehow like reinforce the foundation.
That's a great way to put it.
I'm struggling to understand the physics of that. How does chaos create stability?
Well, it really comes down to what replaces peacetime economic activity. In normal times, markets run almost entirely on forecasting. Corporations and investors are constantly guessing.
Right, trying to predict the future.
Exactly. They're asking, what will consumer demand be next quarter? Or will the central bank raise interest rates? What are our competitors doing? That endless guessing game is what creates everyday market volatility.
Because nobody actually knows the future, so the market is constantly adjusting to new guesses.
Precisely. But the moment a major sustained conflict begins, that entire guessing game is just thrown out the window. It gets replaced by government mandate.
Oh, wow. Okay.
Yeah, you see massive, unprecedented government spending. Defense contracts are handed out with guaranteed multi-year funding. A nation mobilizes, which, often pushes the whole economy to full employment. So for massive corporations, especially in heavy industry, technology, and manufacturing, uncertainty doesn't increase. It drops to near zero.
Because the government basically steps in as the ultimate limitless customer.
Exactly.
Like they aren't guessing if people will buy their tanks or their software. The government has already signed a 10-year contract to buy literally all of it.
Right. The revenue streams become entirely predictable. So while the psychological impact of war on the average citizen is pure anxiety, for the broad industrial stock market, that massive influx of guaranteed capital puts a hard floor under the market.
That is wild.
Yeah. According to the National Bureau of Economic Research data in our source, U.S. stocks actually rose 17% during World War II.
Wow.
And during the Korean War, they went up 19%. That is well above the average historical peacetime return.
Wait, 19%? That's incredible. And even when there is an initial shock right at the outbreak of hostilities, it doesn't seem to last long at all. Like the LPL financial data shows the average S&P 500 drawdown.
The drop from the peak to the lowest trough.
Yeah, exactly. The peak to trough drop after major geopolitical events is only 4.6%. And the market usually recovers in about 6 weeks.
Which is fascinating because 6 weeks is roughly the time it takes for initial human panic to be replaced by revised corporate earnings models.
Oh, that makes so much sense.
Yeah. Once the big institutional investors realize, oh, wait, the defense and industrial spending is actually going to boost bottom lines, the buying just resumes.
Okay, so the broad market gets a floor. But that completely ignores what happens to the actual physical stuff we buy. If the big corporate indexes are doing fine, why do the prices of tangible goods go absolutely crazy? It seems like global trade relies on these incredibly fragile bottlenecks.
It really does. We're shifting from the abstract stock market to the physical ripple effect here. And this is exactly where supply shocks happen. Because while defense contracts stabilize certain sectors, the physical realities of war immediately remove essential raw materials from the global table. And you're totally right to point out the bottlenecks. The geography of global trade is incredibly highly concentrated.
Let's talk about agriculture first, because the source material really highlights Russia and Ukraine. Before the 2022 conflict, they supplied roughly 30% of the world's wheat.
And about 80% of global sunflower oil.
80%. That's almost the entire global supply.
Yeah, Ukraine has historically been the breadbasket of Europe. So when that conflict began, the global market instantly lost access to a massive portion of its fundamental caloric supply.
Wow.
Now, obviously, the demand for food didn't drop. People still need to eat, regardless of what's happening on the news. But the available supply just cratered.
And the mechanism there is so brutal. I mean, within weeks, global wheat futures hit 14-year highs. But, a wheat future isn't just a number on a Bloomberg terminal.
Not at all.
That directly translates to, like, a bakery in Egypt or Lebanon suddenly having to pay triple for the flour they literally need to make daily bread.
Which tips incredibly vulnerable populations right into acute food insecurity. It's this direct transmission mechanism from a geographic choke point to a massive global humanitarian crisis.
Yeah.
And we see the exact same physical mechanism happen in energy.
Right. The Strait of Hormuz is heavily featured in the research. Is a choke point basically like a single blocked lane on a major highway that causes like a 50-mile traffic jam for global trade?
That is the perfect analogy. The Strait of Hormuz is this narrow waterway between Iran and Oman, and it handles roughly 21% of the entire world's oil supply.
Just going right through that one little gap.
Exactly. Any threat to that specific lane of the global highway sends oil markets into an absolute frenzy. Or look at the Suez Canal. In late 2023, Houthi attacks in the Red Sea effectively blocked that route for commercial shipping.
Which forced dozens of major shipping companies to just look at the situation and say, nope, the insurance premiums are way too high, it's too dangerous, and they completely rerouted.
Yeah, they abandoned the ride.
But rerouting isn't just taking the next exit. They had to go all the way around the Cape of Good Hope, down at the southern tip of Africa.
And that detour adds weeks to the journey and thousands of extra miles. Now think about the mechanics of that.
It's got to be so expensive.
Oh, it's massive. You are burning massive amounts of extra bunker fuel. You are paying the crew for extra weeks at sea. The maritime insurance rates just skyrocket.
Right.
Suddenly, a container ship that was supposed to be back in Asia picking up new cargo is delayed by a month, which throws global port scheduling into total chaos.
And the shipping companies obviously aren't just absorbing those extra millions of dollars. They pass those exploded freight costs directly down the line.
Exactly.
So when you, the listener, go buy a t-shirt or a new phone or refrigerator, you are quite literally paying for that rerouted ship.
Yep. Every extra mile that ship travels is just baked right into the baseline inflation of consumer goods.
See, here's where it gets really interesting, though. We're talking about physical choke points, actual ships taking longer routes or grain physically stuck in silos. But the source material pivots to something that moves at the speed of light.
The digital choke points.
Yes, digital and psychological choke points. Now, I'm struggling a bit with this concept of the uncertainty premium. Because if modern markets are mostly driven by automated trading algorithms, why do they panic? It's like someone yelling fire in a crowded theater. But the theater is the global economy, and the ones stampeding for the exits are literally just algorithms. They don't have human emotions.
They don't have emotions, sure, but they are programmed with incredibly strict risk parameters. Think of an algorithmic trading program like the software in a self-driving car.
Okay, I like that.
If the car's sensors detect a shadow darting out into the road that might be a pedestrian, it doesn't pause, analyze the lighting, and, debate if it's just a trick of the eye.
Right, it doesn't have time for a committee meeting.
Exactly. It slams on the brakes instantly. It is programmed to survive first and ask questions later.
Okay, that makes total sense. So in the financial world, what is the shadow darting into the road?
Keywords on social media and news feeds. The article highlights this perfect, honestly terrifying example from the 2026 Iran war scenario. A senior U.S. official, the energy secretary actually, accidentally posted a mistaken tweet on X about a U.S. Navy tanker escort in a contested region.
A single mistaken tweet.
A single tweet. But algorithmic scanners don't read for nuance, right? They scan for proximity. They see Navy, tanker, and escort in the same sentence from a verified government account.
Oh, wow. So the car slams on the brakes.
Instantly. Brent crude, which is the global benchmark for oil prices, plunged toward $80 a barrel and then violently spiked back to nearly $90.
That is a multi-billion-dollar swing in the global valuation of energy happening in literally milliseconds. I mean, long before human analysts could even read the tweet, let alone verify if it was true.
Yeah, the White House issued a correction about 20 minutes later, but the financial damage was already done. The speed of the algorithmic panic vastly outpaces the reality of the physical threat.
Which really proves that information warfare is no longer just about dropping propaganda leaflets. A well-timed digital rumor is a fully weaponized financial tool.
Absolutely.
But it's not just the algorithms, right? The human psychology of waiting for the other shoe to drop seems incredibly powerful. The deep dive sources cite this Reddit analysis of the 2003 Iraq War that looked at market sentiment.
Oh, that's a fascinating study in behavioral economics.
Mhm.
The analysis showed that the agonizing wait for the U.S. to commit to military action actually scared investors far more than the war itself.
Because you can't price an unknown. Like, if you know a war is starting, you can calculate the expected cost. If you're just waiting in limbo, the risk models break down.
Precisely. Once the military action was certain, the uncertainty premium just evaporated. The market could finally model the risk, and stocks actually rallied.
Really? They went up.
They did. Yeah. It proves the old Wall Street adage, markets can handle good news and they can handle bad news, but they cannot handle the unknown.
Which naturally brings us to what happens when governments decide to stop relying on rumors and start deploying deliberate, targeted financial weapons. We're moving into the realm of sanctions and currency manipulation.
Right.
I want to talk about secondary sanctions because primary sanctions make sense. Country A says, we will no longer buy oil from country B. Done. But how do secondary sanctions actually work mechanically? Are they basically forcing the rest of the world to pick a side in a really messy geopolitical divorce?
That is the exact mechanism. Under secondary sanctions, country A says to a neutral country C, you have a choice. You can continue to do business with country B, or you can do business with us. But you cannot do both.
Wow. So you're literally freezing your mutual friends out of your life if they still talk to your ex. And because country A is usually a massive economic powerhouse like the United States, country C really has no choice.
They comply. They have to. And the economic fallout of that forced isolation is just sweeping. Look at the sanctions following the 2022 invasion of Ukraine. Western nations didn't just stop buying Russian goods.
Right.
They went after the actual plumbing of the financial system. They froze hundreds of billions in Russian central bank reserves sitting in foreign accounts, and they cut major Russian banks out of SWIFT.
And SWIFT being the international messaging system that banks use to securely authorize cross-border payments, it's basically the circulatory system of global finance.
Exactly. And the West put a tourniquet on it. The immediate result was capital flight on a massive historic scale.
Break down capital flight for us really quickly. How does a currency actually collapse?
Well, imagine you are a Russian citizen or a business owner. You see the sanctions hit, and you know the domestic economy is about to be isolated.
Right, you panic.
You immediately try to convert your rubles into US dollars or euros because those hold their value globally. But millions of other people are doing the exact same thing at the exact same time.
Okay, a bank run.
Exactly. The banks run out of foreign currency. The central bank, because its reserves are frozen, can't step in to stabilize the market.
Yeah.
Everyone is selling the ruble, nobody is buying it, and the value just plummets. It lost nearly half its value against the US dollar in a matter of days.
And when your currency collapses like that, the cost of importing anything, medicines, electronics, replacement parts for factories, it just skyrockets, creating this vicious cycle of domestic inflation that destroys the middle class.
Yeah, exactly. It's devastating.
So when a currency is collapsing and traditional banking is frozen, investors and citizens obviously look for a lifeboat, a safe haven. Now, wait, hold on. I want to push back on something in the source material here.
Sure.
For the last 10 years, the entire pitch for cryptocurrency has been that it is digital gold.
Right.
It's decentralized, it's immune to central banks collapsing, it's outside the SWIFT system. The whole promise was that when fiat currency fails, crypto saves you. But the research says that narrative completely fell apart.
It did. The reality of how cryptocurrency performed during recent major conflicts was highly contradictory. It forced economists to separate its utility as a tool from its behavior as an asset.
Explain the difference. What does that mean?
Well, on the ground, as a medium of exchange, it had immense utility. We saw Ukrainian citizens and NGOs receiving tens of millions of dollars in crypto donations from around the world. precisely because traditional banking infrastructure was compromised.
Right, that makes sense.
And on the flip side, Russian citizens were using peer-to-peer crypto networks to shield whatever wealth they could from that collapsing ruble. It functioned beautifully as a way to move value across borders without a bank.
So it worked exactly as intended for the people actually caught in the crossfire.
It did, but here's the catch. As a financial asset, as a safe harbor for global institutional investors trying to protect a billion-dollar portfolio from geopolitical risk, it failed the test completely.
Wait, really?
Yeah. In the early stages of the Russia-Ukraine conflict, Bitcoin didn't act like physical gold. It acted like a high-risk tech stock.
Why? If it's supposed to be a hedge against the system, why did it crash when the system was stressed?
Because of who holds the majority of it. The massive institutional funds treat crypto as a speculative high-beta asset. When a war breaks out and global markets panic, these funds face margin calls.
Oh, they need cash.
Exactly. They need cash immediately to cover their traditional bets. So what do they sell? They sell their most liquid, most speculative assets first. They liquidated their crypto holdings to save the rest of their portfolios, causing crypto to crash right alongside a broader stock market.
Wow. So it's not digital gold. When the global theater actually catches fire, the big money isn't running to Bitcoin.
Not at all. They
Yeah.
run to the traditional lifeboats. The true safe havens remain exactly what they have been for decades.
Which are?
Physical gold, which typically surges when geopolitical risk escalates because it has intrinsic value and can't be printed by a desperate government. U.S. Treasury bonds. Because despite any political gridlock, the sheer depth and liquidity of the U.S. government remains the ultimate secure store of value. And historically neutral, highly disciplined fiat currencies like the Swiss franc and the Japanese yen.
Okay, so what does this all mean for the aftermath? We've talked a lot about the acute chaos, the immediate supply shocks, the algorithmic panics, the capital flight. But wars eventually end, borders stabilize, the shooting stops.
Thankfully, yes.
But according to quirky journals, the economic scars are basically permanent. The research introduces this concept of friendshoring. Now, is friendshoring basically deciding to shop exclusively at the expensive local boutique because you just don't trust the cheap big box store across town anymore?
That is a really great way to think about the structural shift we're seeing in global trade. For the last 30 years, global supply chains were built on one primary metric, and that was relentless cost efficiency.
Right, just make it as cheap as possible.
Exactly. Corporations manufactured goods wherever labor, environmental regulations, and materials were the absolute cheapest, completely ignoring the political system of that country.
The cheap big box store. Just get me the lowest price.
Right. But major conflict exposes the extreme fragility of that model. When a war disrupts those cheap supply chains, or when a country is suddenly hit with those secondary sanctions we discussed earlier, corporations wake up and realize that cheap is actually incredibly risky.
Right, because if you save 10% on manufacturing, but your factory gets sanctioned, you lose everything.
Precisely. So they shift to friendshoring. They literally rip up their supply chains and move their manufacturing to politically aligned nations. Nations they trust won't be sanctioned or invaded.
The expensive local boutique. But the boutique costs more. I mean, the labor's more expensive, the regulations are stricter.
It always costs more.
Right.
Prioritizing resilience, redundancy, and political alignment over pure cost efficiency permanently raises the cost floor for goods. You are basically paying a premium for geopolitical security. And when every major corporation in the world starts rerouting their supply chain simultaneously, it creates a lasting structural inflationary legacy. The baseline cost of a smartphone, a car, or a medical device goes up, and it stays up long after the war ends.
And historical precedent shows war has always been a driver of massive inflation. The article mentions World War I, where U.S. consumer prices roughly doubled between 1914 and 1920.
Right, simply because the government was printing massive amounts of fiat money to fund the war effort.
Yeah. But the example that really seems to mirror this modern structural supply chain inflation is the 1973 Yom Kippur War.
Oh, that is the vital case study for anyone trying to understand how conflict rewrites modern economic history. In 1973, Arab members of OPEC imposed an oil embargo on nations supporting Israel.
So a massive, deliberately targeted supply shock.
The mechanism was completely devastating. They restricted supply so aggressively that global oil prices quadrupled from around $3 a barrel to over $12 a barrel within a matter of months.
That's insane.
And this is the one major historical exception to the war puzzle we talked about at the very beginning. In this specific case, the broad stock market, did not stabilize. It went into free fall, declining by 41% over the following year.
Because it wasn't just a distant conflict. The embargo literally choked off the fundamental energy supply that powered the factories of all those industrial companies. I
Mm.
mean, you can have all the government defense contracts in the world, but if you don't have electricity or fuel, you can't build anything.
Exactly. And that physical paralysis triggered a phenomenon called stagflation. This is a highly toxic economic cocktail of high inflation, high unemployment, and stagnant economic growth.
Which is awful.
It is. Before 1973, many economists believed that combination was mechanically impossible. They thought inflation only happened when the economy was red hot and everyone was spending money.
But the embargo proved them wrong. You have prices skyrocketing because oil was artificially scarce, while people were losing their jobs because factories were shutting down. It completely broke the economic models of the time.
It forced Western nations to completely rewrite their strategies. It led to the creation of strategic petroleum reserves, a massive push for fuel efficiency standards in cars, and the beginning of a fundamental diversification away from pure Middle Eastern oil dependence. A single conflict in 1973 dictated the global energy policy for the next 50 years.
Okay, bringing this all together for you listening. The Quirky Journals article paints a picture of extreme, sometimes terrifying volatility, but it also reveals mechanical patterns that we can actually learn from.
Yes, definitely.
The data shows that broad markets usually recover, meaning that panic selling the moment the news breaks is almost always a trap. The best defense against geopolitical risk isn't trying to day trade the headlines. It's preparation over reaction. It's maintaining a diversified portfolio with strategic allocations, things like defense stocks, domestic energy producers, or traditional proven safe havens like physical gold.
If you understand the underlying mechanics, how supply shocks travel through shipping lanes, how the uncertainty premium triggers algorithmic selling, and how capital flight collapses a currency, the chaos of the headlines starts to look less like random destruction and a lot more like a complex but readable system.
Which leaves us with one final lingering thought. Throughout this deep dive, we've seen how physical choke points and essential commodities define the global economy: wheat, oil, natural gas. But the source material briefly mentions another critical choke point on the map: the Strait of Malacca, right near where the U.S. is currently implementing strict export controls on advanced semiconductors going to China.
Which is the single most vital artery for Asian trade and the global technology supply chain.
Exactly. So, if the 1973 oil shock defined the last 50 years of global energy and geopolitics, could a future choke point conflict over semiconductors in Asia trigger a silicon shock? Could the next massive wave of wartime volatility paralyze not just our cars and our shipping lanes, but the very automated trading algorithms and digital technologies we now rely on to navigate these crises in the first place?
That really changes the entire definition of an economic shock.
Something to ponder the next time you're checking your portfolio. That's all for today's deep dive. We'll see you next time.